Glad to have you join us on Business Morning today. I am BC Adebayo. Oil prices are higher today on expectations that OPEC and its allies will extend oil production cuts for at least 3 months, while sentiment was bolstered by news of another promising coronavirus vaccine. Brent crude futures for January rose 0.6% to $44.07 a barrel in early trade. And we saw US WTI crude for December adding 0.4% to about $41.52 a barrel. Now, equity markets rose on hopes of a quicker economic recovery after Moderna said its experimental COVID-19 vaccine was 94.5% effective in preventing infection based on interim late-stage data. Meanwhile, OPEC Plus is set to hold a ministerial committee meeting later today, and that could recommend changes to production quotas when all the ministers meet on November the 30th and December the 1st. Of course, we have our eyes on all of these developments, and we'll be bringing you updates as soon as we know more. Meantime, let's just touch up with the commodities market update. And I have a research analyst at the financial derivatives company, Nosike Nwajide, here with us to talk us through some of the burning economic issues at the markets today. Good morning, Nosike. Thank you for coming on the program.
Always my pleasure.
Now, let's start off with inflation. Now, of course, we saw headline inflation reaching a 32-month high. That's data released yesterday by the NBS. Inflation is now at 14.23%. Even though you guys at the FDC had projected about 14.5%, it's not too far from each other. But then, this didn't come as a surprise, did it?
No, not at all. The consensus is for a continued rise in inflation up until early 2021. The background to this is there's a low interest rate environment and there's a money supply saturation. The fiscal authorities, over the past year or so, since we had the COVID healthcare or health situation, as it were, there's been an increase in basically government spending and deficit financing. So that's surging money supply and the low interest rate environment. There's a lot of liquidity in the system. So that in itself is stoking inflation. Then you have the food inflation, which is at 17.38%. Over the past 5 months, inflation has been basically pushed up by food inflation. But this month, we've seen both the food and the core index move up. The food inflation situation is such that during the time of COVID, the farmers couldn't go out and plant. So you can only harvest what you plant. So during the time of the harvest, we had floods in some parts of the country that wiped away as much as 25% of output. So you have that situation. You have the border closures. You have the farmer herdsmen crisis. You have a lot of constraints to output. So these are pushing food prices really high. In the month of October, obviously there was the NSAS crisis, but we feel that hasn't even been factored into the numbers that we see. That they'll be reflecting.
All right, Nosike, please, apologies, you'll have to hold on to your thoughts. We just need to take a moment, and we'll be right back in just a moment. Welcome back. Now, let's continue the conversation about the burning economic issues at the commodities markets. And Nosike, you were talking about food inflation now and food prices.
Oh, yes. They've been rising over the past 5-6 months from sometime even before April, May, before the outbreak of the COVID-19, and there was a lockdown and disruptions in supply chains, basically. For last month, we had the NSAS further disruptions to supply. People couldn't get supplies from the rural areas to urban centers, and that reflected in the inflation figures across board. You had whether it's month on month, whether it's rural to urban inflation, everything, there was an increase across board. For food prices, the major thing at this point in time is in some parts of the country, because in states like Zamfara State particularly, there's heightened levels of insecurity. We have some case of banditry where you have these bandits who basically ask for ransoms or ask for should I say bribes before you can go in and harvest, and that would also be reflected in the prices that these people sell their products at. So we have that increase in the price of food. There's also increase in the price of imported food, where there's a CBN regulation now that you cannot get forex at the official rates to import food. So everyone resorts to the parallel market, which is the premium between the official and parallel market rates are at somewhere around 60, 70 naira. So you have that 60 to 70 naira increase premium on the dollar for every item that you import. So if every food item you bring in now is brought in at the parallel market. So there's across board, all food items, there's a rise in prices. I mean, even if it's not just the value of the dollar, you have wheat, for instance, that goes into flour and all other things. The price of wheat internationally has been on the rise for the past 3 months. Even the price of cocoa, all food items, domestically and globally, on the rise, and that's reflected in.
And that one wonders what more is to come. The festive season is just around the corner, and let's not forget the recent increase in the pump price of petrol. Even though the Minister of State for Petroleum says that most of the vehicles used to transport these commodities rely on diesel and not petrol, but then won't all of this affect, bring a further increase in the price of commodities in the coming days?
What the minister says is true, but the reality, and it's been our experience, that as soon as there's an increase in PMS prices, it's reflective on every other price, especially logistics costs. From the trailers coming up north, they run on diesel, but the traders, somehow they find a way to factor in those prices.
Because that's a really vital point you raised. They don't run on petrol. So why does the increase in petrol always affect the price of these commodities?
Honestly, it's honestly beyond me, but it's something that we all know, that even if the trailers that run on diesel come to some parts of Lagos, from their depots or from the Mile 2s to whatever markets the food items are being supplied to, they will run on vehicles that use fuel. So, I mean, that might be their justification, but it's our experience that over time, every 5% rise in PMS prices will see more than 5% rise in the price of the cost of logistics. Transport costs will rise and will reflect on the price of transportation and food. And so in the coming months, as you said, the festive season, we would see an increase in demand for food items, an increase in supply as well. But obviously supply, especially food supply is constrained as a result of insufficient planting and constraints to output as well. So, demand is going to be somewhat subdued in this festive season. Obviously, incomes have diminished over the course of the year, so people have lost their jobs. High inflation, obviously erodes purchasing power. So that purchasing power, we expect that consumption, aggregate demand in the next 2-3 months won't be as high as it was last year, for instance. And that might also impact some producers may have already factored that into their plans for Q4. And that might even impact Q4 GDP numbers. It's something that over time, we know that Q4 GDP is I wouldn't say an aberration, but it's higher than because of increased demand, increased supply, as well, increased production and increased consumption. But we expect to see those subdued in the Q4 figures for December and even for January. We have increased PMS prices. You also have increased electricity tariffs. Then you have the PMS prices. The thing with PMS prices, it depends on the exchange rate and oil prices. The oil prices have been, there's been a price deregulation for PMS prices. In the event that oil prices rise, and which we want to happen, we would see a rise in PMS prices. In the event that they fall further to 30, we may not exactly see, maybe a time for oil marketers to recoup some profit, but obviously their cost prices or the landing cost for PMS will fall. But that remains to be seen that if this is passed on to the consumer at this time, it just may be because a lot of people are beginning to ask questions. Okay, PMS prices rise. You tell us, you justify why they rise, but they never fall. When these factors or the parameters that determine the PMS prices so people are beginning to ask questions, and the PPRA, they've said they deregulated the market. So I don't know if they have the authority to set prices at lower prices, and people might just decide to sell at the current 170. So it's something that it will be interesting to see how that plays out.
We'll talk more about oil prices in just a moment now, but I wanted to ask the AFCFTA was ratified last week by the federal government. So if this leads to the reopening, that's the full reopening of our land borders now, will this in any way affect the price of some commodities? Take rice, for instance.
Okay. Rice particularly is something that when the borders were closed, and the borders were shut because of smuggling and security issues and all whatnot. When the borders were closed, Nigerian production, domestic production, was not insufficient to match the consumption, and prices spiked as a result. With the ratification of the African Continental Free Trade Agreement, it's something that we already know that two companies have been giving the permission to use the land borders. It's something that we hope that by January, it will be the land border closures, both on the west and the east and the north, will have to be done away with completely because it goes against the tenets of the agreement. A free trade area requires the movement of people, goods and services unhindered across the countries involved. And at this point in time, putting up the land border, there's no point having restrictions as to movement across the land border. If you want Nigerian goods to be able to move across the borders of the other African countries involved, you should be able to open up your borders to goods from other countries coming in. I don't know if Nigeria at the moment has the capacity to compete with the cost of production in other countries. If for instance, if local rice is selling for upwards of 30-something thousand, and you can produce that at less than that somewhere across the border, and it becomes a problem for the local producer. They will need to find a way to lower their cost to compete. But it's something that would, by the beginning of next year, it's something that we'll see play out and we'll see the dynamics.
So we keep our fingers crossed. Now, let's return to the issue of oil prices. Now, of course, we've seen some relative stability at about $44 per barrel now. But how comfortable should Nigeria be with this new price, apart from the fact that price of petrol, of course, has gone up, but how comfortable looking at the revenue space?
The issue of how comfortable is it's a bit it's give or take basically. There's the vaccines. There's one company, Pfizer, came out. There's Moderna has come out and said that they have a vaccine with 94% efficacy. So that in itself will bolster oil prices, given that the markets will see, okay, the US have said that they are unlikely to have a second round of lockdown, even if we've seen a lockdown in the EU. There's increased Asian demand. The Chinese, there's increased industrial production in China. There's increased consumer demand. There's increased refining, crude processing in China. So all these signs point to a restoration of restoration to pre-COVID levels of activity. All these things will bolster or lend some support to the oil markets, and we see oil prices recover. Then there's the OPEC meeting today, the ministers of OPEC plus countries, and the OPEC meeting of 30th of November and 1st of December. Those meetings are crucial, and markets will wait to see how the meetings play out and see if at the moment, the OPEC Plus have gone from removing about 12 million barrels of oil a day from the market down to, right now, I think about 7.7 million barrels of oil a day. They expect the plan was to take an extra 2 million out by the beginning of next year. But markets would, because the OPEC have come together and seen that, look, we could delay this for another 3 to 6 months and see how the levels of inventory, how the glut in the markets, if the glut in the markets will fade away, given that we have the outlook for consumer demand or oil demand outlook was a bit gloomy. But given this restoration of Asian demand, the vaccines that are lending support to the outlook, they may delay this restoration of output cuts and see how everything plays out, which should lend some support to oil prices. You might be seeing oil prices get to 46, 47 in the coming days and weeks. Is everything goes out as planned, and it should, obviously, the fiscal space, as you said, it should narrow the fiscal deficit. Nigeria is more oil price and production sensitive, so it's crucial to see how it plays out with regards to our quota, our OPEC plus quota. Nigeria's quota is about 1.41 million barrels a day, and Nigeria has been overproducing for quite some time. So it's going through a period of compensatory cuts, which I think ends sometime before the year runs out. So if it's done with that, then it can start producing at 1.41 million barrels a day. And if everything goes as planned and OPEC stays the same, as in the quotas don't change, I mean, with increased price at 1.41 million barrels a day, it's below previous years where we were producing as much as 1.5, 1.6 million barrels a day. But giving all the options before us, I mean, it's the best scenario we could hope for.
All right. So with all of this now, what would be your outlook for oil prices in the coming days?
I think the meeting today is crucial. I think with the vaccines that have I've seen positive outcomes, and with the testing and all whatnot, we should see market prices rally somewhere to about 45 in the coming days. If the outcome of the meeting today is that they would push, or if it's beginning to look more and more likely that they will push back their decision to take 2 million barrels of oil off the market to sometime in April or June next year.
All right, now let's talk about the currencies. Now, of course, we've seen the Naira hover around 475 to the dollar at the parallel markets, and of course, about 607 to the pound.
Okay, obviously, the CBN has been going through, there's a period of rationing. There's pent-up demand, and there's a backlog that it needs to clear. So it's rationing. That rationing is taking place, and reserves are falling at the same time. Obviously, the forex receipts from crude oil prices are a bit, just above 40 at the moment. So with the reserves falling gradually, it's been steadily falling over the past couple of months even. Okay, there was a slight period of increase, but it's been falling in the last couple of weeks. With reserves falling, and investors, just every day you're looking at the reserves and watching them fall slowly, there's a bit, and obviously low interest rates, as I pointed out initially, there's increased liquidity, and there's increased demand for forex. So that affects the value of the currency. And another major thing is the value of the US dollar. Value of the US dollar is the currency used for global trade. But at the moment, the uncertainty with the US election has seen some, I don't know, erosion of confidence, as it were. So investors are a bit nervous as to what's going to happen, what's going to play out. Is Trump not going to leave office? What's going to happen by January when he's supposed to leave office and Biden's supposed to take over? What's going to happen? So the markets are a bit nervous. So you're seeing the dollar lose some value against other major currencies. So the Naira has fallen against the dollar. It's also fallen more against currencies like the pound. So while the dollar is losing value, the Naira is losing value at a faster pace, so to speak. But in time, if oil prices rebound and we see external reserves have some accretion, it should steady. It should steady back to
exactly. I was going to talk about the reserves. I mean, oil prices have been, on an upward trajectory in the past couple of days. So we're not seeing some sort of reflection on the reserves. Why is that?
It's, well, like I said, the CBN keeps rationing. Nigeria is more sensitive to oil production than to oil prices. So if we're steadily or gradually moving towards compliance as to 1.41 million barrels a day, and we might even have to, like I said, compensatory cuts go lower than 1.41 million barrels a day, our oil earnings, oil receipts will fall, and this will reflect on external reserves. So we expect that to continue. Hopefully, the compensatory cuts by the end of this year would have done all the compensatory cuts that we need to do and return to 1.41 so that we can see reserves start rising back up and give investors some confidence. Because the more it falls, the more people will demand for that so that they can exit and not have to face the depreciation, the value of the assets, so to speak.
All right, research analyst at the FDC, Nosiki Mwajide, thank you for coming on the program.
Always my pleasure.
We'll talk more about the recent increase of petroleum prices when we return in just a moment. Please stay with us. Welcome back. The Minister of State for Petroleum Resources, Timipre Silva, has been reacting to the criticism trailing the new pump price of petrol. He attributes the hike in the price to the fluctuation in the global crude oil prices. He told State House correspondents on Monday, after briefing the president, that generally prices of petroleum products are greatly influenced by global market forces. Let's listen to him.
The price of crude oil go up, then it means that the price of the feedstock has gone higher. It will also affect the price of the refined product. And that is why you see that product prices are usually not static. It depends on the price of crude oil, which goes up and down. That is why we say deregulate, so that as the price go up or down, you begin to go up and down as well at the pump. Before now, we fixed it, which was not optimal for us as a country. So we say, look, our earnings are not fixed because our earnings are dependent on crude oil price. If we fix it at this end, then it becomes unsustainable at some point. So let us keep it floating so that if crude oil prices go up, then you will see a reflection of that. If crude oil prices go lower, you see a reflection of that at the pump. Now, what happened recently was because of the announcement of a vaccine for COVID by Pfizer. With that, crude oil prices went up a little bit. If you've been following crude oil prices, you would have seen that crude oil prices went up a little bit as a result of this announcement. So when crude oil prices go up a little bit, then you will see that instantly reflect on the price of petrol, which is a derivative of crude oil. So that is why you see that there is this movement, and if we listen to ourselves, this is the same explanation we've been given. That if crude oil, when the pump prices came down, we reduced the pump price because it reflected. We saw that crude oil prices were lower, so we reduced the pump price when we deregulated. Then when the crude oil prices went up, it went up. When it's coming down, it goes down. That is how it is. So that is why you will be seeing this go up and down in the marketplace. And we have also now introduced the alternative fuel, which is gas, because we feel that at least it's important for Nigerians to have another option, which will be cheaper.
Now, no doubt Nigeria's oil sector has had its fair share of ups and downs in recent times, ranging from the recently suspended strike embarked upon by members of the Petroleum and Natural Gas Senior Staff Association of Nigeria, PENGASSN, over the implementation of the Integrated Payroll and Personnel Information System, IPIS, and the latest increase in the pump price of petrol, which, of course, is still generating several reactions. But let's put all of these into perspective with the president of the Petroleum and Natural Gas Senior Staff Association of Nigeria, PENGASSN, Mr. Festus Osifo, who's right here with us in the studio. Good morning, Mr. Osifo. Thank you for making out time to be with us today.
Good morning, BC. It's a pleasure to be here. Good morning, Nigerians.
All right. I'd like to get your reaction, first of all, to what the Minister of State just said, talking about what the reason behind the increase in the pump price of petrol. How does his explanations sit with you?
Yes. For us in PENGASSN, what we have attributed to over the years is that if you want to do deregulation, let the deregulation not be import-dependent deregulation. Let the deregulation be based on local production and local capacity to produce. So what we have today is an import-dependent deregulation. But clearly, it is not even a deregulation as it is today. Because when you deregulate a market, what that means is that a lot of players will come into that space. But what we have today, a lot of the major marketers, they are not importing PMS. The reason they are not importing PMS is practically because of the fact that the field is not level. The environment is not conducive for them. Because if you look at it, PPMC, for example, they get USD from government at a particular rate. So if other companies, other major marketers, if they go in, at the end of the day, they don't get the USD at that given rate. And once they don't get it, let's assume that a particular player is getting USD, let's assume, at about 350 naira per dollar. Then another one is getting at about 380, for example, or 390. You see the disparity. So because of that, most of these other companies, they are not interested in importing fuel. So when you deregulate, what that means is that you remove your hand totally and you allow market forces to determine the price. So it will basically demand and supply. But the way it is today, it is still a bit controlled. So what we actually want is, if you want to deregulate fully, but you must improve your local refining capacity. And that is why in Pengassan, we have driven to the point that the Port Harcourt refineries that they are about to revitalize, that is why we pushed that in Pengassan and the end of even our sister trade union, NUPENG, will be represented in the steering committee as well as the validation committee. The steering committee is the highest level committee that we see to the workability of the Port Harcourt refineries. Yes, from what we've seen, we are a bit satisfied with some of the programs and some of the timelines that have been developed in order to rehabilitate Port Harcourt refinery. It is not actually turnaround maintenance. Turnaround maintenance is something that you do every now and then, say every 2 years. But these refineries, they've been neglected for a very, very long time. So what they need today is a total rehabilitation. And they are starting from Port Harcourt refinery. And on our part, as trade union, we are going to follow them up to ensure that they keep to those timelines.
All right, now we'll touch more about the refineries in just a moment, but I just want to take you back to the issue of the regulation now. With all that is happening with the state of economy, many are asking if this is actually the best time to do this, looking at the impact on the purchasing power of Nigerians.
Yes, we understand, I've had this argument here before at a time, is that today, looking at the global pandemic, today, looking at the fact that a lot of people, they have lost their real income, looking at even the inflation, as of yesterday, the inflation figure was released, and it was about 14.23%. So, year on year. So, basically, it shows that there are some fundamentals and some indices in the economy that is not just right. But again, looking at it from the larger sphere, you realize that, in 2012, there was also an attempted deregulation by the Goodluck regime. It was resisted. The organized labor, the TUC then, NLC, they came out vehemently to resist it. And we also told them, between that 2012 and where we are today in 2020, if the government, if they were serious, today they could have, we could have been self-sufficient in production of PMS. You see, one thing we should realize as well is that if you import crude oil, or rather if you export crude oil and you import PMS, that PMS that you are importing is dollar-based. So what that means eventually is that as you are bringing in the crude oil, the PMS, you are importing jobs. Or rather, you are a lot of our jobs, we are going to have issues with them. Because if you bring in crude PMS at the end of the day, most jobs that we have in Nigeria, because refineries are not working, then we are going to have issues with the job. So now, basically for us, what we've advocated over the years is that you must improve the local refining capacity. But again, today, I think as well that if government want to deregulate, if they deregulate fully, I believe even the price will come down because more players will come in. So the operating environment should be a bit level for all players so that the major marketers, the independent marketers, they will be able to import PMS. Why putting modalities in place to ensure that the local refining capacity is enhanced? Because, like what I was trying to explain a while ago, that the PMS refine abroad, the people that work there, you are paying them in dollars. But if you are producing it in Nigeria, you are paying them in naira. So if you devalue your currency, the dollar component is going to be the same, but the naira component is going to reduce. So at the end of the day, you are using cheaper workforce to produce the same quantity of PMS, unlike when you import this PMS. So for us, we are pushing government so hard for us to improve our local refining capacity.
Okay, so I was just going to ask now that you're pushing so hard here. So what's your assessment of the body language of the government towards reviving these refineries? Of course, the minister also pointed that the staff are still there, they're getting paid. So what does this tell you?
Yes, like what we've advocated in the past is that the staff are still there, but you are not giving them the tools to work. So if you don't give them the tools to work, if you don't create the right environment for them to work, because it is the management normally that should provide that environment and provide the tool for the employees to work. Today, this is channels. We have cameras everywhere. If these cameras are not here, and if the environment is not conducive, we will not be here today discussing. So the government and the management should provide the employees the tools to work. So when that is done, I believe clearly that our members, they will be able to deliver. We have people of a very high level of capacity and intellect working in these refineries. They are there today. The refineries are not working to no fault of theirs. Because if you are supposed to be maintaining refineries once every 2 years, for example, you carry out turnaround maintenance. In this turnaround maintenance, there are budgets for them. I mean, you are supposed to budget for it, you plan for it. So if the management is not coming forth with such plan, the employees have little or nothing to do. So what we've advocated is that the 3 refineries, or plus the other one in Port Harcourt, making 4, we should put plans in place to ensure that they will come to life. But what we are seeing in Port Harcourt refinery and the traction that has been made, we are a bit okay. But let that be replicated in Warri refinery and in Kaduna refinery, because we have the requisite manpower to deliver on that.
Now, your association has constantly called for the adoption of the NLNG model in operating the refineries, where the federal government has a share, but to have the likes of Shell and Chevron actually operating. Right. So how would this help over-reliance, in the importation of petroleum products?
Yes. The plan today is that, first of all, let us rehabilitate the refineries. Once we rehabilitate the refineries and they are working very well, then the refinery we can now bring in different model. And what we've advocated is the NLNG model, because today NLNG is a flagship. It is working because it is a private and public partnership. So we must develop that for our refineries. When we do that, in Nigeria today, we are having issues government running business. These refineries are not working basically today because it is run by government. The same refineries that are built in other parts of the world, there are refineries in France, there are refineries in other parts of the world that were built the same year with the Port Harcourt refinery. I can tell you that they are working 24/7. So for us, what we advocate is that after rehabilitating these refineries, we will bring in the private sector. So let there be, it could be 51-49. To the private or to government, depending on how the arrangement will be. Because if the private people that are running refineries all over the world, if we allow them to run these refineries, we strongly believe that we will not find ourselves in this sorry state again.
All right, now let's shift gear to your recently suspended strike action. That's by your members, Pengassan members, talking about the eyepiece system now. So now the strike has been suspended. Does that mean that the federal government has actually acceded to all of your demands?
Yes. Some of the issues that we had then was that 22-month arrears, salary shortfalls to one of our branch, NNRA, that has been owed for a very long time. It wasn't paid. As at last week, they've released about 50% of that money to our members. And the other 50%, there are plans that before the end of November, they should be able to get the other 50%. So that is for the 22 months arrears. Then for PPPROA, everything is sorted. The monthly salaries, they've all received. So they are all fine in PPPROA. Then in PTI as well, it's also okay. So I could say that by and large, we got about 80% of what we asked for, while the other 20%, we are still discussing that. So relatively, it came out positive. But what we want to encourage government is that let us not wait for us to go on strike before issues are being addressed. Some of these issues, they've been there since 2014. Some of them, they've been there since 2018. So we want to advocate the part of dialogue that Pengassan always stood for over the years, that when there are issues, because we attempt to engage, we reach out to them, but we want to encourage them that they should take those reach out as seriously as possible. They shouldn't wait for us to down tools before they will come and listen or accede to some of our demands. So that is our encouragement. But in general, I think it was fine. I think our members are relatively happy. The few other issues remaining, we are trying to address them behind the scene.
All right, as we prepare to round up this conversation now, once again, what should the federal government actually do to ease the burden on the people? And this is me referring to issues like the increase in the price of petrol once again. How can the government help to actually cushion the effects of this on the people?
Yes. In every developed economy, there are some forms of subsidy. In every developed economy, there are things the government always do to ease the burden on people. I heard the last time the president gave an address, making an illustration of Saudi Arabia, for example. In Saudi Arabia, you realize that their per capita income, it's almost times 50 of Nigerian per capita income. In Saudi Arabia, for example, you realize that they have good infrastructures, they have a lot of things going for them. They have subsidies in a lot of other areas. So we shouldn't just look at one aspect and pick it out. So for me, I think that government should be responsive to the people. I think that government should bring about some level of palliatives to the people. And I also think as well that we should not allow the forces of demand supply, the variation in our USD. Because if today, if there's a devaluation in Naira and it goes down to about 500 Naira officially, without the crude oil price going up, we are going to see increment in the price of crude oil because we are exporting, increment in the price of PMS because we are actually exporting, we are importing this crude oil, this PMS as well. So that is the fundamental problem.
Would like to thank you, President of the Petroleum and Natural Gas Senior Staff Association of Nigeria, Pengassan, Mr. Festus Osifo. Thank you so much for coming on the program.
Thanks a lot. I appreciate it. Thanks a lot.
All right, now let's run through yesterday's numbers at the Nigerian stock markets, where, of course, the correction continued, and that led to a 0.8% decline in the oil share index. And the markets saw major sell-offs on Tier 1 banks, talking about Zenith Bank, which was down 4.2%, and GT Bank, which was down 1.1%. But let's, before I get to that, let's talk about the total volume of trades, which declined 46.3% to 668.53 million units at value of 7.85 billion naira in exchange in 10,313 deals. But let's bring in an analyst at Cardinal Stone Research, Michael Nwakala, to get more on what shaped yesterday's trading and, of course, what to expect today. Many thanks, Mr. Nwakala, for joining us on the program. Of course, we saw the market correction continue at the market yesterday. Are we likely to see that happen again today?
Yes, so thank you for having me. Yes, so like you said, what we saw yesterday was another healthy correction in the market. The market has basically been on a tear for the last eight consecutive weeks. It has closed up constantly in eight consecutive weeks, and Nigeria is currently the best performing equity markets on a local currency denominated basis. So on Friday, we saw an 86 basis point correction, and yesterday we saw a 69 basis point correction. Going into today's session, it's likely that we will see some more pullback. Investors are basically concerned about justifying prices at these current levels. But that being said, I don't expect a large pullback for the rest of the week because investors are also, especially for institutional investors, they are on the sidelines waiting for the fundamentally justified stocks to drop to a justifiable level before they kind of come back into the market. So I do expect people to keep taking profit of the substantial gains we've seen in the last few weeks, but I don't expect prices, or I expect to see a lot of support for asset prices as the week continues. One of the biggest questions that investors have is if they sell off their current holdings, be it in the bond market or in the equity market, where do they put the excess cash, right? And this is especially the case for bonds with yields at 0.3% on the 1-year bill and even less on shorter dated bills.
All right, Michael. I know we could go on and on, but I'm afraid time will not permit us. We need to end this conversation at this point. But we do appreciate your time, Michael Nwakala, analyst at Cardinal Stone Research. We'll take a trip to London when we return in just a moment. You stay with us. Juliana Olayinka is ready for us to analyze some of the headlines coming from the UK this morning. Good morning, Juliana. Let's start with Brexit. Now, EU diplomats are warning Britain that time was fast running out for a Brexit deal, and that's just as Brexit party leader Nigel Farage is also saying that Brexit is under significant threat, criticizing Boris Johnson's leadership. Talk us through all of these, Juliana.
Well, it's pretty difficult, I'm afraid, Bissy, because we just don't have an update. It's been ongoing back and forth for the past couple of weeks. Michel Barnier, the EU's chief negotiator, has been in London. It's the turn of Downing Street in Brussels this week. Lord David Frost, who's leading the negotiations for this side, has been in Brussels. And what we do know, what's been made clear this morning, it's the same rhetoric, really. David Frost is saying that a deal is ready and can be delivered by next week. But again, this pushes back the time to ratify the deal. We do know that on January the 31st, that Britain did officially leave the EU, but we won't be leaving the single market or the customs union until the end of the year. And that is running out. And Boris Johnson, the Prime Minister, has been pretty tough about the red lines involving fisheries, red lines involving governance, level playing field. They said they're not willing to budge. That's what Britain have said. They've been pretty strong on that. And all of the junior ministers and the senior cabinet ministers that have been speaking in the British press have been saying that they are willing to walk away. So it's not looking good, and the time is running out, as you said. One of the other pressing issues, which is as fundamental issues, is this internal market bill, this new piece of legislation that passed through the Commons, didn't pass through the House of Lords, but it only needs to pass through twice in one house, which it already has in the House of Commons. This is basically going to rip up some parts of the international treaty to protect Britain's sovereignty over Northern Ireland. Now, on the weekend, the Irish Foreign Affairs Minister, Simon Coveney, did say that it's absolutely going to be impossible for EU member states to ratify the deal in Parliament, whilst acknowledging that Britain have ripped up the withdrawal agreement treaty. So although we're getting sound bites on both sides saying that a deal could be done, time's running out. The EU are not happy with the internal market bill. 6 weeks ago, it is highly likely that there will be no deal and Britain will come crashing out of the EU.
All right, and meanwhile, news has it that PM Johnson has left the door open for the return of his key advisors, talking about Dominic Cummings and Lee Cain, following the dramatic departures from number 10. How true is this?
We don't know if it's true. If it is true, it would be certainly a sensational return, but it's going to be very unlikely. Of course, before Prime Minister Boris Johnson went into self-isolation yesterday, Downing Street was engulfed in this storm. Some were calling it EastEnders, which is a popular soap here in Britain, just because it had become so messy, and it did involve his key chief aide, Dominic Cummings, who is a really kind of polarising figure here in Britain. Some have called him a bully, a tyrant, too tough, taking Boris Johnson and the Conservative Party in one direction that was completely isolating some stronghold members of the government. Apparently, it also involves Boris Johnson's fiancée, Carrie Simons, who's also the mother of his 8-month-old child. And she's not just a fiancée, because she was a pretty senior figure in the Conservative Party before she hooked up with the Prime Minister. And she has some very strong views, and her views won on the day. And Dominic Cummings and Lee Cain, the communications director, have left. Some of the speculation from the reports you're suggesting is that Prime Minister Boris Johnson has left the door open, and that if these guys want to come back to try and help the Conservative Party push through a win in the 2023 election, so be it. But I think for now, it's fair to say that we won't be seeing them back in number 10 anytime soon.
In other news, Juliana, workers at Heathrow are to go on strike for 4 days in December. Now, the workers are accused in the airport of pressuring staff to accept worse contracts or resign. Can you tell us more about this?
Well, yeah, this has been an ongoing story. Heathrow Airport quite typically brought up or dragged into these kind of strikes, but of course COVID-19 strikes a completely different note. Many of the staff, I believe 4,000 staff, which includes firefighters, engineers, operations, security and baggage staff, they're being represented by the Unite Union. They're not happy with the fact that the vast majority of them have had their contracts removed when they're being told to re-sign these contracts. Many of the contracts are just not good enough. A lot of their salary has been chopped off, 20% up to £8,000 for some of the staff. Heathrow, of course, are saying there's nothing that they can do. This hiring and rehiring is not a scheme. It's just to keep people at work. Heathrow, of course, quite famously was pushed off by Charles de Gaulle Airport as Europe's busiest airport. In fact, in September, Heathrow has actually now gone down to the 10th busiest airport. Even one airport in Turkey is busier than Heathrow at the moment. Passenger numbers in October were down 82%. The fact that we're in a national lockdown could show that in November it could be down as 95%. So Heathrow are not happy. These strikes are going to take place, very important for people to note actually, on December the 1st, December the 14th, December the 17th and December the 18th. In response, Heathrow have said to Unite it's deeply disappointing that Unite has decided to take strike action during the worst crisis to hit the aviation sector. We will now activate extensive contingency plans which will keep the airport open and operating safely throughout this period.
We'll see how everything plays out in the end, Juliana. Thank you, and do enjoy the rest of your day.
Thank you.
And back home now, let's bring in the head FX trading at Evian Quest Merchant Bank, Ajibola Phillips, for an insight into activities at the currencies market this morning. Good morning, Ajibola. Thank you for joining us. Can you talk us through the latest development at the Forex market? Of course, we saw the Naira close flat at 386 to the dollar at the INE window and depreciate by about 1% at the parallel markets. Talk us through all of these developments.
Hi, good morning. Thanks for having me. Market is still a bit calm this morning. We're still going through the motions of just what happened yesterday. Market is trading at the similar levels in the INE market. We're still trading around 386. There's not been a lot of liquidity in the market, but the market has kind of steadied around that level. There's been some intervention by central bank for the FBI specifically yesterday. Today we don't expect a whole lot of activity in terms of flows. We expect that any flows that might come will probably come from local non-bank corporates, just like they've been doing since the exit of FBI inflows generally in the market. So we expect that the high market is going to become quiet and trade around the 386%, $386 level.
Head FX trading at Evian Quest Merchant Bank, Ajibola Phillips. Thank you for speaking with us. And that's where we end today's program. Thank you for watching. I am BC Adebayo.